little video about SMT, like I was saying on Twitter. This is for mainly people who trade like me. Well, not that I'm saying I created the style, but ICT sort of style of trading. And I'm just making this because I feel like some people don't use SMT either like properly, or like if you're not using it at all and you're trying to trade draws on liquidity, etc., then I think you're missing a big part of the puzzle basically. So yeah. Right, so start off with I'm just gonna talk about the basics of SMT. I'm gonna assume a lot of people know what it is because it's on ICT's YouTube channel and stuff like that. But basically, it's just a cracking correlation in assets. So like so I've got some examples on the screen here. So on the left, so basically when you're trading Euro USD or GBP USD, you're basically assuming that they will behave like the same, sort of not the same, but I'll show you. So as you can see here, like when Euro creates this high and then comes down, GU creates this high and then comes down, then we go back up. Now you would assume that it's because Euro didn't take this high, GU wouldn't take this high, this buy side liquidity. So when there's a crack here, so GU does take the high, takes the buy stops, and then moves down. But EU doesn't. So we can say there's a crack in correlation here, and we would focus EU to short. If you were bearish bias, obviously we have to incorporate a bias into this all the time. You can't just use this blindly. This is our example of the daily time frame SMT. So it's more like a daily swing point, and we would identify the swing point by looking at the time and date that it formed. So if we're looking at this daily swing point here, we're thinking 31st of October. This is just like a fake date. The 31st of October high here, it gets taken here, but not here. So now we have SMT. Now we can look at Euro USD and GBP USD as a pair for SMT, but we can also use Dixie, the dollar, for SMT, but we use it slightly differently here. So like I said, when Euro makes a high, comes down, comes up towards the high, it doesn't take the high, so then you would assume that the dollar wouldn't take this low, so it would do this. And if it did do this, there'll be no SMT, but it came down to take the low, and then rallied. So now we would focus the Euro to get short on. Again, if we had a bearish bias coming into this, I can't use it. But I just want to mention a quick thing, if you didn't know already. So we have low resistance liquidity and high resistance liquidity. So this chart example here would be an example of high resistance liquidity because it took this high here and broke this low, so it would have a hard time breaking this high. And now this here on its own would be considered low resistance liquidity, these two highs here, because they're equal highs, no stops were taken. And maybe if we were looking at price here after taking this low, we might, or some people might, without seeing this SMT here, might look for longs up to these equal highs. But due to the SMT, we can say that these highs here aren't as much as a draw or a draw at all, because we've taken stops on GU but not on EU. This makes EU the weaker pair, and we would look to scout shorts on EU, essentially on a retrace up into here, into some sort of PDRA in here. I mean, this is very basic drawing, only one time frame. So same with the dollar here. So obviously this is would be considered a low resistance liquidity because the equal highs here. This would be considered a high resistance liquidity. So you might look to trade into this low resistance liquidity here without seeing this SMT here. And that's why I think SMT is a really important thing to incorporate into your trading, because for example, let's say you're trading EU only, like you're an EU trader. I see a lot of people only trading EU, right? And you're trading with in the back of your mind, you've got a draw of liquidity. So you're going to trade, your bias is going to be, let's say, bearish until a certain low. But what happens if, let's just open a fresh chart here. We'll get this chart open. It's fine. Yeah, so let's get the path tool. Okay, yeah, so you're trading EU, right? And EU comes down here. It creates your what some people refer to as like a smart money reversal, whatever. Get your low risk buy form in here. Second distribution. And now here, alright, obviously we'll draw some sort of daily premium fair value gap here. Right, so now you're trading EU only. Your vision, the tunnel vision on this one pair. And now, so obviously this is your draw of liquidity. Let's call it the draw of liquidity. Blah 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 blah. You're trading here. Here. Here, right? Let's say this is your position. And your target's here. You don't even need to have a position necessarily. Right. So now price comes to this point, right? It's not hit your TP. And you're thinking, okay, it's got to go down. Like this is the draw. I'm short until here. Maybe it starts rallying a little bit. Maybe enter another short. Maybe enter another short here. Because right, you're still bearish. I mean, there's no reason to be bullish, right? Looking at this chart alone. But now, on the other hand, GU, same shit. Right, GU is this chart here. Okay, we've got the same draw of liquidity, let's say. You're short biased until this low is taken, right? Because you want to see some sort of reversal off the low. Now, GU comes down and takes out the low, whereas EU only comes to this point here. So now there's no draw of liquidity lower, and you might be looking to trade higher into some premium arrays higher up. So now you're fucked basically, because you're still seeing this short bias here, but the liquidity's already been taken here. See, there's no this EU can safely rally without having. Alright, let's have a look at some examples here, right? So first of all, to get this layout here, you need to get TradingView Premium, I think it is. I'm not sure to get the two layouts, but the free one won't do it. So here you want to have two charts. So you press this here, and then you want the same crosshair at the same time. Well, this is what I use. So let's look here. This is the same error of price action. Okay, so let's look at this low here on Euro. These lows here. So as you can see, these lows got taken here. But let's look at the same lows here. You can see the crosshair hovers over the same low. Here, right? So now we can say, so where did the low get taken? It was on this move down here. So these lows here are now confirming SMT, right? So can you see that? Because these lows here were not taken, but on Euro these lows were taken, and you can see the date and time. So Monday the 14th of November, these are the lows that we're talking about here. So now I would focus on GU here for longs, right? So that's just an example. You can see that this is hindsight, but you can see the move up that's happened after Euro took the lows and GU didn't. You can see the move up. You can see how GU moved a lot quicker to the buy side liquidity up here. So this is more of a higher time frame that use of SMT. But you can also kind of see how if you're just trading GU, you might think, alright, let's have a look. So here, right, if your bias is bearish, you might be trying to short. This is not a trade I would take, whatever, but you might try to be shorting until these equal lows here. I mean, they are equal, like it's a valid draw on liquidity in theory. But when you incorporate GU and dollar I mean, EU and the dollar into this equation. It's not. So let's say people are still taking bearish PD arrays, trying to short, trying to short into these lows. You can see it just gets blasted into this high. Lower time frame example here, and we can actually look at it from today. I think we're on the 15-minute. All right, so let's have a look. All right. So this little range here is the Asian range. It's an indicator. And on Euro, we can see on the Euro, we can see that the Asian low was taken here. But on GU, it wasn't taken. So we now have the SMT. And if you don't use SMT, you might think, okay, look, we can see that Asia high got taken. We might be trying to short still. And then obviously you can see that this 15-minute fair value gap formed. Yeah, you can see the fair value gap formed, and we might scout a short entry. I mean, personally wouldn't, but yeah, so we might be trying to scout shorts on like the 1 minute around here into these equal lows, quote unquote equal lows. But again, this low is not a draw now because we took it on the Euro. Do you know what I'm saying? So we're missing out on the bias here because we're still holding that bias. Just during Asia, like as you can see, GU took this low here. EU didn't. That's bullish for EU, but obviously this is what we're looking at here. It's the same low, but yeah, don't get confused because obviously this low here on the right is this low here, but it's the same concept because we came and took this low out day on. We can also look on 1 minute, 30 second, even a lot of different time frames. I'm going to find an example now for you. All right, we can see it on ES and NQ today. This is another pair that you can use for SMT. So you can use GBP USD, Euro USD together. You can use Euro USD and the dollar. You can use GBP USD and the dollar. You can use ES and NQ together. And you can also incorporate the US 30, but I personally don't think I don't see a point in it. So here, just very this is a very hindsight. I did not trade this trade, but it's just an example of things you can be looking out for. Like SMT is very powerful. So obviously, you have to be very particular about the times, and that's how you can find the best SMT. So here on ES, we made this low. We had these short-term lows here, long-term low, short-term low. Secret. So this low here and this low here. This is an example of SMT because ES came down, didn't take the low. NQ did, so focus this pair. Fair value gap forms. I mean, you probably get slipped up to like here. Stop here. I'll probably target like this high here, 1.2R. Right. There's also another example of it here. So obviously we get the rally up. And obviously NQ is not really trading at the same pace as ES at this point. So this low here that I've marked here, look on the left. Look on the left, you see, it's this low here. Doesn't get taken on ES, rallies away. But on NQ we come down one more time and take it. We form another. There's no fair value. There's no fair value gap immediately formed, but there is one here. Also order blocks, whatever. 30 seconds is not really. Yeah, it's not my thing necessarily, but yeah. So just two examples there of There's all these things you should be looking out for. Trade two. You can always like if you want to carry on trading one pair, just one pair, you can. Like, yeah, don't get me wrong, but I think you should be very wary of SMT at all times. All right, cool. I don't know if I explained that well, or also don't come at me if you think it's wrong or not wrong, but like you think there's some slight variance to how you trade it or whatever. This is just how I use it, how I learn it from certain people, ICT, etc. So yeah, apologies if it's a bit of a shit video. I don't really know how if I explained it well, whatever. Yeah, so cool.